So here, this chapter we have till now we have already discussed about financial reporting, everything regarding financial reporting, balance sheet, P&L notes, and all those stuff, output calculations. Now, what we are going to deal is a new area of development in finance. You might have heard about CSR reporting, corporate social responsibility reporting. So in that, usually companies used to say, okay, we did charity of this much amount. We give, like when you drive through the national main road, you might see for in Ramadan, we fed around 100,000 people in Africa and those things. This is part of CSR, corporate social responsibility. So it's why, because the companies does this is it's part of giving back to the society. Because even though we are paying taxes, everything, and this tax is going to benefit the public, but still there is a social responsibility for us. Because, for example, if you talk about Pepsi or Coca-Cola, they have factories in our place. So what they do is they take the water from underground. This water is supposed to be used by the public staying nearby. So even though they are getting the resources free, even for us, anyone running a company, we are using the oxygen, which is for others. So part of that we have to give back to the society. So a lot of companies start giving back to society and they start reporting that, okay, we spent this much. So, but there was something missing. By doing that, what I accrue, okay, I spent $1 billion on charity. What is my benefit? And there is few questions that is done by the company, but which is not recorded anywhere. Like for example, company sends you for a training. It's actually value addition for the company, right? So when you do charity and you publish, people get a good image of you. So that's kind of a promotion for you. Second thing, when you train your employees, it's additional benefit for you, because when you train them, they are going to give you more output. The people will be seeing you as an organization. Organization means it's nothing, right? It's all about people. They will see quality people in your organization. It will boost the business. So this is all kind of investment for the company. So these things were not recorded or evaluated anywhere before. Now they started doing that. So for that, we got this integrated reporting. Here we will discuss about integrated reporting. What is integrated reporting? Then integrated thinking and integrated reporting. So what is integrated reporting? Integrated thinking means when we need to report something like CSR and you combine with your financial data, as an accountant, as a management accountant, you always have to think when you get an invoice or an expense, you need to think, okay, this is a training expense, for example. If this is an HR training for employees, you should think whether there is anything which is having a value addition or not. Got it. Sometimes there is value addition is there, sometimes value reduction also happens, because our fund is going for the training and we get in back training for them. So normally this were expense stuff. This is not accounting anymore. So now we start reporting. So for a management accountant to think about integrated reporting, you need to understand how to think about integrated reporting. Yeah. So that thing we will discuss. Then fundamental concept of integrated reporting, then guiding principles and common elements of integrated reporting. So here in integrated reporting, unless what we see in IFRS, is International Financial Reporting Standards, there they have given what you have to report, how you have to report. For example, for leases or capital accounting or equity, how to record they have mentioned. How is the journal entry? How much you have to do? What to apportion? All these things are mentioned. Here in this case, nothing is mentioned. They have given you concept. Okay, this is what integrated reporting. So this is the framework. Inside that, you can do anything. Yeah, you are supposed to report few things. Okay, when you report those things, it's finished. It's upon you how you report it. Clear. Next, adoption of integrated reporting in organizations. Now, we'll go to the topic. Many organizations have begun to report more than just their financial status. As investors, regulators, and society have become more demanding, especially in the wake of 2008 financial crisis, the quest for not only financial information but also non-financial information has grown. Now, when you see some charity organizations, they also prepare receipt and payment accounts, right? Then they will show you how much they received, how much they spent. They never show how much they spend for the public. Like they are for an orphanage, they will never report how many kids are there in the orphanage, how many old people are there, how much facility they are gaining. They are not reporting. They are reporting only financial data. It will not help for an investor or a person who is donating. So the investors or who are interested or stakeholders, they need non-financial information also. Got it? Yeah. The past, additional information was presented in separate published sustainability reports or corporate social responsibility reports. But many organizations worldwide are now shifting towards an integrated report. An integrated report is designed to provide a holistic view of the organization by connecting financial and non-financial information to the long-term value creation possibilities of the organization. Here we will study about the International Integrated Reporting Council's formats and frameworks. So, how integrated reporting came into the market? Why we are doing this integrated reporting? Traditionally, the main goal of corporate reporting was disclosing the organization financial information to increase transparency and accountability. Our organization had came to own more intangible assets from before it was only 17%, and now almost companies have intangible assets 80%. Does your companies have any intangible assets in your company?
Intangible assets.
Yeah.
Intangible assets, we paid like initial store opening fee. Whenever we are opening an outlet, we are paying to the franchisor store opening fee.
Yeah, franchisee fees. It's an intangible asset. Then these are the few things what people remember, but we have paid for software. No one counts, right? Because we are using multiple softwares like billing softwares. We have a lot of softwares we are using. So all intangible assets and trainings we give to employees is one of the main intangible assets we have. So these things, because of that, when we start accounting, that we came to know that is 80% and more. We are having that. Yeah. To represent this value accurately, organization began to provide more non-financial information, often in the form of separate CSR report. However, such information was usually scattered and incomplete and often lacked consistency and comparability. Now, by integrated reporting, what it brings is that they brought a format like kind of framework every organization should report these things, like human capital increase or fund increasing, those things. So everyone will report those headings, so we can compare with other organizations. Clear? Okay. Integrated reporting is a relatively new concept. It gained momentum when the creation of the International Integrated Reporting Council (IARC) in 2010. This global entity composed of regulators, organizations, accounting firms, and standard setters issued the International Integrated Reporting Framework in 2013. This principle-based framework gives guidance to organizations preparing integrated reports. The objective is to bring together capital allocation and corporate activities to create natural well-being and sustainable expansion through the use of integrated thinking and integrated reporting. Although the integrated reporting framework primarily focuses on providers of financial capital in the private sector, its mission is for integrated reporting to become the worldwide corporate reporting standards for both private and public companies. Now, we're concentrating only on private companies. Like integrated reporting. As said in the beginning, integrated reporting framework or integrated reporting is a process founded on integrating thinking that results in a periodic integrated report by an organization about value creation over time and later communications regarding aspects of value creation. So now integrated reporting is what? Is a process. Integrated reporting means we are calling it as a process. That process is called integrated reporting. By that process, what do you do? Your process is done on the basis of integrated thinking. Okay. With that integrated thinking, you prepare integrated report. Now, this definition of integrated reporting requires an understanding of three major concepts: what is integrated thinking, integrated report, and value creation. Okay. Now we will go in detail all these things. So these three concepts will be explained later. Although Integrated reporting, an organization is able to explain how strategy, corporate governance, employee and management performance, and prospects lead to value creation over time. As we said, as a basic example, value creation is HR, training HR. Ultimately, we are creating value by spending some money. Then we might have like research and development. R&D is actually value creation. We are trying to build some intangible assets like royalty, patents, and copyrights. So there also value creation happens, but at the cost of something else. We have to pay something, or we have to do a kind of research which will create pollution. So here we will discuss about 5 types of capitals, like environmental capital, human capital, then financial capital, focus. Then okay. Through IR, an organization is able to explain how strategy, competitive governance, employee and management performance and prospect lead to value creation over time. In the context of the entity's external environment, value is created by providing a combination of financial and non-financial information. Then reporting enables an organization to tell its own unique story of value creation. Now, see, when you invest in some company as an investor, and they show you P&L balance sheet, the financial data, and they give you CSR report. In that, they say they spend this much amount. As an investor, you don't know where they spend, what is the benefit public is going to have, or what is the benefit this organization itself is going to have. So when you say, okay, for example, my company is Johnson and Johnson. I invested in Johnson and Johnson. It's basically child care products they are developing. So they show some donations as about 1 million or 2 million. So I need to know where did they spend? If they have spent in between the kids, okay, then ultimately this is going to come back to us. Clear. If they have spent this to older people, there is no use. So this kind of understanding the investors will get. Okay. Now, so integrated reporting process is based on integrated thinking within the organization and the integrated reporting framework. This concept interact. IR is not a static concept but a process that continuously improves reporting, internal decision making, and integrated thinking. Write a white paper, E is equal to MC square, and I will give you. Will you understand anything? E is equal to MC square. I write this and give to you in a white paper. You don't understand anything? I have seen that. Okay, you have seen that. Yeah, this is a physics formula, right? Even I don't know in detail. So that's what integrated thinking is. When you know about something, you will think, okay, when you see this, okay, you will think, okay, this is physics. That means he's intending to say something about physics. Got it. The same way in integrated reporting, when you know what is integrated reporting, you will, whenever you see things, you will think on that logic or that perspective. Clear? That is what integrated reporting. Now, integrated thinking is a process of decision making, maximum reporting. It is based on the connectivity and interdependence among the organization's specific factors that affect the organization's ability to create value over time. So when you get a expense invoice, you will check whether this is a normal expense or this expense is going to create a value in your organization. Clear. You might have just spent something for a dustbin or what we say garbage bin with your labor. Normally, what we do, write it as an expense, right? The miscellaneous expense or something, cleaning expense. But when you understand, okay, this you can report as integrated reporting or CSR because you have donated for this public, and you even deposit garbage there, but still public also deposit. So you are creating a value to the organization. Clear. Integrated thinking is a prerequisite of integrated reporting. Understanding the influences financial and non-financial factors have on each other is necessary to report in an integrated manner about the performance of the organization and make well-informed decisions for long-term value creation. Got it? Next. Through integrated thinking, an organization learns how the interdependence among its financial and non-financial aspects interact and affect value creation. Thus, integrated thinking is the basis for the external communicated integrated report. Integrated thinking cannot be done on a standalone department. Different departments must work together to measure and report the value creation of the organization for both itself and its environment. Then comes integrated report. The product of integrated reporting and integrated thinking is the integrated report. Clear. In the context of the organization's external environment, an integrated report concisely communicate how strategy, governance, performance, and prospects lead to value creation over the short, medium, and long term. Okay. So as I said, when you put your logo in a waste garbage box and you put it somewhere, people can use. Initially, people might not notice your logo, but after 3, 4 years or 5 years, people will know about your logo, right? Somewhere, okay, they will think, "Ah, I have seen this somewhere." That's kind of marketing strategy you have. Clear. Next, okay. So that's what the medium, short term, medium, and long term objectives you have. Okay. Then integrated reports should be prepared in accordance with the integrated reporting framework published in 2013 by IARC. And the integrated report provides a holistic view of the organization for all 11 stakeholders. That means when you report something in integrated reporting, it is not only for shareholders, it is not only for employees, it's not only for customers or suppliers, it's for everyone who is interested in your organization, even the general public, government. Like, what is the interest of a government in your organization? The amount of tax you pay, right? That's what their interest. As a public, they need to know, for example, I don't buy any product of your company, but I stay nearby you. So what my interest is how much pollution you're creating. Okay, how it is going to affect me. As a customer need to know how quality goods you are providing. Okay, what is your stand on quality products? As a supplier, they need to know how much fund you have. As a shareholder, they need to know how much wealth you are creating, how long you can create wealth. Clear. So these are all things you will report in your integrated report. In your financial statement, you will report only profits and losses, right? It's only useful for shareholders, suppliers, customers, and investors, prospective investors. Now, and daily report is not a mere combination of the annual report with a separate sustainability or corporate social responsibility report. It should be designated identifiable communication. Clear? It's not. I prepare my financial statement and I attach my CSR report also with that. I can't say it is an integrated report. I need to do it separately. Whatever they have mentioned, I have to show it. Okay? You look like I am showing some Chinese movie here. You know Chinese?
About this integration of
Okay.
the integrated reporting and the financial reporting. How is our profit and loss?
Yeah, that's what I will. Okay.
So we're getting, I'm familiar with CSR. You're big on CSR. You see, sir, that slide? You see? You see that tower?
Second, I will just hold it.
This is off the record.
Yeah. Then next, the purpose of the integrated report. The main goal of an organization's integrated report is to give providers of financial capital more information about how the entity creates value over a period of time. Providers of financial capital means the investors. They need to know, like for example, when an investor invests in your company and he sees your P&L, profit and loss account, and he sees HR cost as 2 million, 3 million, or 5 million, he will think of why you are paying this much money to people. Out of this, 1 million is for employees training. So this will give a value addition for him. Unless the company doesn't report in integrated reporting, he will never know. This 1 million is for the company's growth. You're paying. Got it. Now, an integrated report also benefits other stakeholders who are invested in the entity's effectiveness of creating value, such as employees, customers, suppliers, communities in which the entity is located, and assorted regulators. Clear? Like when you say about sustainability, you change all your lights and you move to LED lights. Ultimately, you will get a benefit as an employee because some companies close their business because the cost is higher, their utility cost is higher. Now you turn to LED, your utility bill is less. So they company, if they want, they can provide something for their employees in future maybe. Not now. Don't ask now.
We're against the threshold from the time that we are not replacing until the time that we're replacing PLD.
Okay.
That's how we compare it when it comes to reporting and stakeholders.
So you are replacing every year LEDs?
So it's already replaced. It's already
Okay.
completed project. We're just doing standing.
Okay. Next. Fundamental concept of integrated reporting. The main purpose of integrated reporting is to show how an organization creates value over time. And in this value creation process is influenced by external environment in which the organization operates, relationships with stakeholders, and various resources. That is 6 capitals. We will discuss it later. Now, so an organization's value is created by, first of all, the external environment in which it operates, right? For example, I run an organization here and I make trouble with everyone here. Like, for example, when we came here, there were some people. If I wanted to fight, I would have fight. But I didn't fight. 5 minutes. You take your time. Why? Being diplomatic because I need to run this organization tomorrow also here. I need to see them tomorrow also. So in my environment itself, I am creating enemies. How can I run the organization? If I run a factory here and I have trouble with the people living here nearby, then I can't run my business, right? They will make trouble for me always. So that's one thing. Clear. So it's actually good names or goodwill, whatever the value we are creating. Then relationship stakeholders means relationship with employees, relationship with shareholders, investors, creditors, suppliers. So we are good businessmen. We do a lot of business. We make a lot of profit, but we never pay our suppliers on time. It's a bad one. Clear. So such things are not here. Then here, how this 6 capitals is going to influence the organization is what we will discuss. Then these topics are addressed in the integrated report based on 3 required fundamentals, that is value creation, the 6 capitals, and value creation process. By focusing on the fundamental concept defined in the integrated reporting framework, an organization provides not only financial information but also context about its operation and goals over the short, medium, and long term. Yes. Fundamental concept one that is value creation. So when an organization sells a product, it creates value for itself and indirectly to the customers. Right? When you buy something from a shop, for example, I bought this laptop. For me, this laptop is a value which I got for the money which I paid. For the company, the money which I paid is a value created for you. Clear? Right? Both of them are getting something, right? Like barter system. You pay and take something because you don't simply go and purchase something which is not used for you. Right? For example, you don't have any use with a laptop. Will you buy that? No. You already have 5 laptops at home. Because the company advertised this is a good laptop, you will never go and buy. Unless otherwise you have utility with that, you will never buy. So when you buy that, you are making a value addition for you or value creation for you. And the company is also having a value creation. That's the sales amount which you receive. So for the company, it's in the form of revenue value addition, and for the customer, a form of which depends on the nature of the goods or services sold. Then this process affects not only the financial aspect of the organization, but also its reputation and its relationship with its stakeholders. What if, for example, I sell a computer? Okay, tell me, you all guys use laptops, right? Which laptop you suggest? If I want to buy a laptop, which one you will suggest? Which company? There's a lot of companies, right? Which one you should suggest?
Depends on what you're going to do. Like if you
Okay, for example, I am an animation artist or graphic designer. I need
there is a good laptop from Lenovo.
okay, Lenovo. So this is why, because you might have used a Lenovo and you had good experience. For me, I would say Dell professional computer is one thing. Business laptops, they are good. Why? Because this is what is what do we say? the reputation that our organization created on. The first product if I bought from them was a, for example, you said Lenovo. I went to Lenovo shop and I bought a Lenovo, but it is not working as I expected. Now I have a bad image of the organization. I will never buy. And if you say you're going to buy Lenovo, I will say no, I don't buy. Okay, so that is one. So that's based on the quality what the organization gives. So whenever we talk about Japanese product and Chinese product, we say okay, Chinese is cheaper. Even if they give you a high quality product, also still the 99% of their products are cheaper products. So you will think, okay, this is also cheaper, even though they have quality there. Got it. So that's the reputation we have. Then in selling products to customers, an organization is operating within a social environment and the outcomes of these interactions after the organization's social license to operate. That's called a social license to operate. If you are, for example, you are the Lenovo company and I am a customer and we have a solid relationship, then in my family I have around 2,500 people. When I call for a marriage, there is 2,500 people. None of them will buy your product. Got it. So that is how, if we are having a good relationship, then I'm giving a social license to operate. As a society, we accept, okay, that's a good company. We had even sometimes the product may be bad. You might buy some product because of the customer care representative or the salesperson standing there, right? They will convince you, they are very good to you. Because of that, you might purchase something. So that will also give social license to operate for the organization. Good. When the value created for the organization for itself or for others is material, it should be incorporated into the integrated reporting. If it's for small amounts, you don't need to add to your integrated reporting. If the material amount, huge amounts, then you will record in your integrated reporting. Clear? Then, externalities also need to be included in the integrated reporting. Externalities are the positive and negative effects on the capitals not owned by the organization itself. That means the pollution would create outside. We run a factory, the polluted chemicals we are putting outside our compound, but it is in the public river or pond or outside somewhere. So it is also creating a negative effect on the organization. Clear? Now, fundamental concept two, that is the capitals. The value creation depends on different sources defined as 6 capitals. So when value creation happens, it happens either of in this space. For example, if I sell something to you and I get revenue, in which capital you will add? A financial capital, right? And for example, as we were talking about Deva, or even when you go to ATM, they will ask you, go eco-friendly, don't print the receipt, we will email you. When we are doing that, or that organization is doing that, it is adding to their natural capital. They're giving back to the environment. Clear? Then manufactured capital, that means it depends upon how much machineries you have. So when you buy machineries, your financial capital is going negative and your manufactured capital is going positive. Correct. That's an in and out flow. When intellectual capital, like when you are doing your research or when you have copyright patents and those stuff, you become your intellectual capital. Then comes the human capital, where your HR cost or employees' expenses will come. Then social and relationship capital, like this is how where you treat your nearby people, your customers, your society, and how you pay your taxes, how you deal with your government. This all gives you the social and relationship capital. Yeah. 6 capitals are affected by the regular course of business. That is, they are increased, decreased, or transformed by the activities and outputs of the organization. For example, by selling a product and making a profit, financial capital increases. By having a toxic substance leak in a plant, natural or environmental capital is decreased. Filing a patent on new product, intellectual capital is increased. And not all capitals are equally important for an organization, given organization. Also, sometimes one capital may need to decrease in order to make other capital increase. value can be created over different capitals and is not necessarily measured in financial capital. Like when you say you train your employees, actually expense you're paying, and this payment you are giving to the training company. Ultimately, it's going outside. Your money is going, your financial capital is decreasing, but what happens? Your human resource capital is increasing. Now, value creation in the sense of integrated reporting is not only seen as an increase in the overall stock of capital, but also a preservation of its overall value. So sometimes when you do expenses, it might not create value, but still it will preserve you in the market. It will give you a good image. People will start buying. At least people will maintain buying from you. Yeah. So what is all this capital? Financial capital is available pool of funds. It's a liquid capital available through financing for producing production of goods or provision of services, example, equity, debt, investment, or operational activities. Then natural capital consists of renewable and non-renewable resources, non-renewable environmental resources, and processes that provide goods or service that support the organization's prosperity. Okay, these include land, water, air, minerals, biodiversity, and ecosystems. Clear? Then, manufactured capital consists of manufactured tangible objects. It is a physical capital, not natural capital, available for the production of goods or provision of services. Examples include property, plant, and equipment, and infrastructure such as roads and ports. Then manufacturing capital is not about ownership, but about availability of tangible objects. For example, the closure of a port, the company relies on due to political irregularities decreases its manufacturing capital, even though the port is not owned by the company itself. For example, you think this Khalifa port closed. And ultimately, what happens? A lot of freight forwarding companies or even normal companies are relying on Khalifa port. Now, what will happen there? Either their expense increases because they will consider this as their manufactured capital. Clear. When this closes, they will either have to ship to Dubai or they have to transport goods from the Dubai port to here. Clear. So this will increase, affect them in one or other way. Right. Intellectual capital is a tangible. The intangible knowledge of the organization, which includes intellectual property, example, software, patents, copyrights, and licenses, and organization capital, example, systems, procedures, and protocols, like the bylaws, the HR policies you have, ethics policies you have. This all comes under your intellectual capital. Then employees' competencies are not intellectual capital; they can be transferred to another organization. Clear? Next one, human capital, refers to employees' competencies, abilities, and experience, including training and development, availability and willingness to understand and implement the organization's strategy, loyalty to the organization and motivation for the job, and support for governance, risk management, and ethics. Okay. Then social and relationship capital is the relationship of the organization with the environment in which it operates. This includes network between and among the organization's stakeholders, institutions, communities, and shareholders. Brand recognition and external reputation of the organization. Key stakeholders' willingness to share information, maintain the values and goals of the organization, and keep in touch with the organization. The organization's social license to operate is called the social relationship capital. Yeah. So how we are going to report these capitals in the Indian report? So for an organization, it depends on organization to organization. Like we might have heard about KPIs, key performance indicators, or what we say, critical success factors, CSF. Okay. So kind of this in KPI for different organizations it's different. Like for example, if I'm running a hospital, for me the KPI is the number of beds which is occupied, or if it's a clinic, a number of customers and like what we say, outpatient, occupations came. Depends on organization to organization. Or for example, for a textiles, how many units they sold. This maybe the KPIs. So same way in financial capital, how we calculate whether the capital increased or decreased. Depending upon the organization, the metrics will be different. Like, for example, it's a financial product, like financial service company in North America, they use return on equity, ROE, as a benchmark. What we say, the KPI, kind of KPI. When it increases or decreases, they will say, okay, financial capital increased or decreased. Okay. So we will read those for portion and before. So all 6 categories will not be present in every integrated reporting. Okay. And some categories may not be relevant for a particular organization. Capitals may not be identified by the same name in every integrated report. Then organizations are allowed to show the change in value of the capitals by combining them or by using different names. And an integrated report may not be structured using the 6 categories. The categories merely show how and through which value is created for the organization. It's the capitals ensure that organizations at least think about all the different forms of capital affected by their operations. Clear? Next, for example. So when you talk about a natural capital, for example, if you take Coca-Cola, they calculate their natural capital on the use of water resources they used. On that basis, they will say how much natural capital they have consumed. Clear? Then for the postal company, for the carbon emissions per package delivered, I think we might have seen this in FedEx or somewhere. In FedEx invoice, they used to put this, or Amex, I don't remember this. One of the courier company here, they show that how much carbon emission they have. Then manufactured capital, yeah, mining infrastructure going below the ground. So this particular company, that is Royal Platinum Limited, and for the translate, that is multi-cargo ports and rolling stocks they have. Then intellectual capital, that is based on investments in research and development. And for human capital is like skilled and experienced employees, how much they have. The number of new students attracted, number of new students joined the organization, then employee injury rates. Like in some companies, what happens there is like, I think you might have Qatar when they prepared for this World Cup. They had a lot of injuries and all. On that basis, there was a lot of issues happening. Part of that, it will be shown in the human capital. Yeah. Then social responsibility. Like for airport, network destination, like Dubai airport used to advertise this, right? They have flights to 150 destinations around the world, something. That's part of Indian reporting. Then Clorox, how they calculate is that how much employees they volunteer hours they do. Okay. Next fundamental concept is that the value creation process. How does the value is created? So now we discuss about what are the values and what are the capitals and what are the capital metrics we use. Now, how this value is created? So value is created through a business process. We have an input, we have a business process, we have an output, and we have an outcome. Output is different, outcome is different. In my company, I produce milk. That is my output. When you drink my milk, you might die. That is the outcome. Okay. Now, the value creation process consists of the following elements: that is, inputs are resources and relationships, capitals used in the business activities. The organization obtains input from the external environment. Business models transform input through business activities into outputs and outcomes. A business model is sensitive to changes in the quality, cost, and availability of inputs. It may or may not be able to adapt quickly to changes like business models. For example, my company is a courier company. Yours is also a courier company. I might be working in a different style. You might be working in a different style. For example, Aramex. I don't think Aramex have their aircraft, but FedEx have their own aircraft. Clear. So this is their business model, different business models they have. Next one, okay. Business activities are the core of the business model that transforms the input into output. Okay, and outputs are the results of the organization's business activities. Outputs may be products, services, or byproducts or waste. Then outcomes are the internal and external effect of business activities and outputs on capital. Outcomes relate directly to the external environment and are not necessarily controlled by the organization. Okay, the outcomes determine the status for new inputs. In this sense, the value creation process is circular. Okay. If my output is not in a good quality, my outcome will be bad. They will not come back to me to purchase anymore. Yeah. One small bit, if you have some water and compare. Guiding principles and content elements of the integrative report. Overview of the guiding principles. Preparing an integrative report involves a certain challenges. What is that challenges? If I want to implement integrative reporting in my organization, I need to train my employees. They need to know what is integrative reporting. Otherwise, if my accountant doesn't know, he will simply account that as an expense. For example, I have an accountant who doesn't know costing. Then when he enter into the system, he will never refer this to a costing element. Then it will not be booked there. Clear? So it's the same way here also. So preparing an integrative report involves certain challenges. The guiding principles are designed by the IARC to help prepare for integrative reports for some information. The guiding principles are guidelines and cannot always be applied strictly. Judgment is needed in applying these guidelines because they sometimes conflict. Hence, consensus and commitment must be get in conflict. Like for example, when you say certain expenses you want to record completely. When you record completely, it will not reflect the integrative reporting concept. Clear. The guiding principles. Strategic focus and future orientation. The report should indicate how the strategy affects the ability to create value in the short, medium, and long term, how the strategy affects the capitals, and how the availability, quality, and affordability of capitals contribute to create value. Clear? So first we need to think how our strategy is going to help the integrated reporting. Clear? Next. Connectivity of information. The integrated report should show a holistic picture of the interrelatedness of the different aspects of the organization. The report should explain how these factors affect the ability of the organization to create value over time. So when you say about integrated reporting, okay, have you people brought any organic food from somewhere, anywhere? Organic products?
It's expensive.
Expensive.
But
But still, when you see that, have you ever thought that, okay, how I can trust this product? They say it is organic. How I will know it is organic? So to know that, I need to know the chain, how they are connected, like from where they purchase, whether they are organic company. For example, if I am purchasing fruits, I need to know from where they buy the seeds or they buy the chemicals or what is fertilizers they use, whether they are organic or not. For this, there is some organization who certifies this, and there is a list of suppliers and customers who they can only purchase from these people, and they do the regular audits for these companies. This is how they regulate this organic market. But still, the same way here also, here in an organization, every department is interconnected and every department has a responsibility for integrated reporting. For example, a purchase person. Okay, for example, our strategy, because when I worked in one company, I have seen an agreement of, Zara, Poland, so I was working with a company who was a supplier for Zara. So where we had an agreement with Zara, in that the Zara's condition was this: okay, we as a supplier, we don't labor children. Child labor we are not using, and we don't have gender inequality. We pay ladies and gents the same salary. We have to sign in the contract and give this. This is how they, because this part of their CSR or Indian reporting, they need to know as a supplier we are following it or not. Because this is their strategy, whether we are following or not. This is how they ensure. Clear. There's one the connectivity of information. Then, as an organization, they need to know whether the supplier is doing their things properly. So they will have interconnected, what we say, data collection also. Every department will know that we are going for integrated reporting, and we need to report everything which is connected for the value creation. Yeah. The integrated report should show a holistic picture of the interrelatedness of different aspects of the organization. The report should explain how these factors affect the ability of the organization to create value over time. Next, stakeholders relationship. The key stakeholders and the quality of the relationship with the organization should be reported. Then materiality. The organization should disclose information that has a substantial effect on its ability to create value over time. Got it? And conciseness and the integrated report should be clear and concise. A judgment must be made as to what information should be reported in the report. What should be reported and what should not be reported, we should know. Next, reliability of the and completeness. An integrated report should be free of material errors. An integrated report must include all material information, whether it is positive or negative. Some organizations are there, they will just simply highlight the positive sides. Yeah. It should not be there. You should report your negative side also. Okay. Then consistency and comparability, the material information, the material information in an integrated report should be consistent over time. Changes and improvements made should be explained. And comparability among organizations is difficult due to application of the integrated framework to the specific situation of each organization. Yeah. Because different companies follow different methods of reporting. They, for example, for some companies, human capital is important. For some other companies, human capital is not so important. Clear. Then, overview of content elements. Each integrated report should contain 9 content elements. So one of the each content is explained in higher reporting framework and includes one question that should be answered in the integrated report. Answering questions rather than checking off a list of requirements makes the content of the integrated report adaptable for different organizations in different situations. So here, the 9 content elements are question basis. Okay. There is a question. Okay, for example, if why you are going to office? I will say for salary. Then I will ask you why you want a salary. Because I have a family to feed. Why you have a family? Why you live bachelor? So this question, when you plot something in question, you can ask to anyone. The same way here, for any organization, if you plot these 9 questions, it will answer all the integrated reporting questions. Relationship among certain elements. No. So the content elements are related. The information gathered from answering these questions should be presented in a logical way. So your question starts here. The content elements and questions posted include the following: organization overview and external environment. This is one element. For this element, what we ask is the question: what does the organization do, and what are the circumstances under which it operates? Then it's to understand an organization. For example, when you join in the class, what did I ask you? Your name, which company you work, what is your product. So now from that I understood what the organization does and what are the circumstances under which it operates. Like you work in, for example, in so and so company, it is in restaurant business and cafe business, or yours in a real estate business or in construction company. So I will understand what circumstances you work. Clear. So that's what for every company we will ask this question. So they will answer you. Right. Okay, this industry. So you will know what you expect from for the next time. Clear. In the next step. So an integrated report identifies the market in which the organization operates, its mission and vision, competitive landscape, qualitative information, stakeholders need, external environment changes and reactions to external environmental changes. So now, when I ask this question, I will understand. So I will not assume that, for example, yours is a construction company. I will not assume that your strategy is that medicine for cancer. I will never think. Clear. So I can align whatever data I get according to this question. Clear? Yes. Governance. Or to understand the company's governance, what policy they are following, we'll ask this question. How does the organization's governance structure support its ability to create value in the short, medium, and long term? So these three questions should be addressed by the organization. Yeah. An integrative report provides insight about an organization's leadership, structure, leadership, strategy, decision-making process, values and ethics, and linkage between remuneration and value creation. Remuneration and value creation. So now, see, even you can ask this question like, what is your short-term, medium and long-term goals? As we said, CEO, CFO levels. Depends on that, right? When you have your short-term goals, it should be based on your long-term goals, right? If you want to become a CEO after 15 years, you need to become like operational manager at least in next year, 10 years or 5 years. So to reach there, you need to do something now, currently for short-term plans. So this is how for the organization also. Okay. Then business model. What is the organization's business model? An organization's business model is part of its value creation process and is usually supported by a narrative identification of critical stakeholders and other dependencies and diagram or flowchart. Whenever we work in an organization, you might get either sometimes you get a data flow chart like in a process, for example, when you're processing receivables, you have a data flow, right? Like when you process an invoice, this is what all documents you should have. From there on, you have to get the approval. For example, you don't have a customer PO. So you will have a flow chart. Whether you receive the invoice, yes. Whether it is having customer PO, no. If it's no, ask like what we say sales team. So you will go and ask the sales team. When they provide it, the question will be yes or no. Yes, I got it. You will come back and you will attach the next document. So this is a document flow chart. Got it? Yeah.
Because for me, I automatically reject it. Why should I get billing from sales team? It's part of the requirements, right?
Okay.
So I'm just looking at the rate of this. Oh, yeah, I don't do that. I don't do that extra mile. It's automatically rejected.
Next comes risk and opportunities. So, what are the specific risks and opportunities that affect the organization's ability to create value over the short, medium, and long term? And how is the organization dealing with that? Okay, so when you decide your short term, medium, and long term goals, now you will think, okay, what is stopping me from doing that? That is the risk part, right? Risk element. So when you will think about the risk and what are the opportunities you have for each and every short, medium, and long term goals. Risk and opportunities may be internal, external, or a combination. An assessment of materiality should be made in the event that the identified risk actually occurs. As we said, the opportunity and risk may be internal and external. Internal is that okay, I want to become a CEO, but there is something stopping me. I'm not confident. So then you have to work on your confidence. Maybe that's external. You don't have opportunity. You are staying in a world country where you don't have opportunity. You move to another country where you get opportunity. Okay. Strategy and resource allocation, where does the organization want to go and how does it is intended to go? Okay. Based on your vision or mission statement. Okay. So strategic objectives, resources allocation plans, and measures of goals achievement are also included. This content element is closely linked to the business model and external environment and comes performance. If you want to check about the organization's performance, you will ask this question: to what extent has the organization achieved its strategic objectives for the period, and what or its outcome in terms of effects on the capitals. Yeah. Just like you compare your actuals with your budgets, whether you achieve your budget or your personal goals, whether you achieve or not. Quantitative and quantitative measures should be used. Linkage between historical performance and future plans are important. Connection between financial performance and performance of other capitals can be made. Outlook. Outlook means how does the organization look forward, or what is your perspective, organization's perspective. So here, where changes and uncertainties in the organization likely to encounter in pursuing its strategy, and what are the potential implications for its business model and your future performance. So an analysis is usually made of expectations about the future, possible changes and responses, and the organization's ability to react to those changes. Yeah. So how we are going to deal the uncertainties what you are going to face. Then basis of preparation and presentation. Here, how does the organization determine what matters to include in the integrated report, and how are such matters qualified or evaluated? Quantified or evaluated. Thank you. This is all. When you know about integrated reporting, you see an expense, or when you see an event, you will understand whether to report it or not. Okay, so that's all. Or how does the organization determine what matter, what is to be included in the integrated reporting or not? So an overview of the materiality determination process, often shown as materiality metrics, is provided. Normally, organization will set up, like for example, when you spend $1,000 or more for employee training, you have to show, or more than $1,000 you are spending for public, you have to record it in integrated reporting. Yeah, there's a materiality threshold, how much you have to show. Then the organization identifies the reporting standards and other frameworks used in its preparation. Yeah. Then general reporting guidelines. Yeah. This item in the current element is not based on a question. It provides information about essential issues that should be considered during the preparation process, such as materiality, capital disclosure, and the explanation of the business model. So how, so for an organization, there is external and internal environment. Okay. So here you have all the capital in the beginning of the year, for example, if you're talking about a year, and you will check the capital at the end of the year. How much financial capital increase or decrease? How much the natural capital increase or decrease? How does the natural capital or whatever the capital is increase or decrease on the basis of your business model? Right. How the input is taken, business activities, then outputs and outcomes will create a plus or minus in any of your capitals. Clear? Then, what else? Then this is how what you report. Your business model you will report. Governance, strategy and resource allocation, opportunities and risks, future outlook and performance. Yeah. Adoption of integrated reporting. Finish. I'm okay. I will be burnt if you look like this. It's done. Now this is the easiest part. Okay. So whenever someone asks you something and ask you, okay, for example, I ask you, what is my bad qualities? It's easy for you to find out in the email. If I ask you, okay, what is good about me? Even though you know what is good about me, you will be reluctant to say, right? The same way here, when you adopt integrated reporting, what are the challenges? Okay, the color got changed, right?
Yeah.
It's an indication. Oh,
There is the current question.
it's
Is it not under smart feet? Is it smart feet? Is it smart feet?
I think so. Maybe not. No? Okay. Now, challenges. An organization must be aware of the following concepts and challenges. That is materiality, because IR follows a multiple capital approach. A provider needs a materiality filter. That means what amount is material and what is not material, the organization should know. For example, what financial capital information does a user of the report want to know? A successful start to integrated reporting requires a proper materiality definition process. Clear. Then data quality, because material matters are communicated in the report. The quality of non-financial data relied is one is crucial. Internal controls of or for financial report, non-financial data must ensure quality. Like for financial data, we have proper internal control system. We have checks and verifications. For the non-financial data, normal companies, they don't have a control measure. Correct. So we need to ensure that that data what is provided is correct. So when they say they provided lunch for or food for 100,000 people, they should have accountability, like whether they provided or not. Yeah. Maybe sometimes they give money to someone to pay for 100,000 meals, and he might have flew with this money. This can also happen, right? Next, assurance. Although validating integrated reporting and more specifically non-financial data may be difficult, it enhances the quality and comparability of integrated reports. Clear. First one, the data what you are giving is correct or wrong. If you want to ensure it, it's very difficult. If you can do it, then your report will be in a very good quality. Next, lack of standards. No universal accounting accepted standards exist for measuring and reporting value creation and non-financial information, making it difficult to communicate this kind of information. Okay, got it. Then adoption of the integrated reporting framework, as well as other frameworks such as the Global Reporting Initiative or Sustainability Accounting Standard Board can help overcome this problem. Then down at the top, when you are implementing anything in the organization, the top management should have an initiative about that. Correct. Now, possibly the most important aspect in the success of internal reporting is the down at the top. To adopt integrated reporting, support from the CEO and the board of directors is absolutely necessary. Next. Building the business case for integrated reporting. The adoption of integrated report has many challenges and benefits. Stressing these benefits can help build a business case for integrated reporting worldwide. The benefit of integrated reporting includes linking financial and non-financial information, which provides more clarity about the value creation process. The watch better decision making and resource allocation, better relationship with stakeholders, more employee engagement, lower reputational risk, more committed customers, better measurement and internal control systems for non-financial information, breaking down silos with the organization by requiring different departments to work together to produce. Means like breaking down the ice. Say, for example, when you work in an organization, always you have problem with finance team. You have problem with HR team. So now when you implement an integrated reporting system, all people need to work together. Yeah, yeah, thank you. To avoid the conflict. Then lower cost of, for example, debt and equity over long term. Why? Because when you report your non-financial data also, banks will be knowing, okay, you are doing these first things. Then it will be easy for you to raise money from bank, even from the shareholders. People will be interested in investing in your companies. Like in India, we had some stationery company, ITC, I think. They were selling notebooks. In that last page, they have written 1 dirham, 1 rupee. They are donating for poor people. This is the only thing they wrote. Because of that, their books were 5 rupees costlier, but still people used to buy that book. Got it? No. Then Indian reporting incurs cost. So when you report financial accounting, still you need an accountant. When you report costing, you need an additional accountant, or you have to train this one who you have. When you are going to implement integrated reporting, you have to train him, and he need to have time to do that also. In addition to his regular work, he have to do the integrated reporting also. So it has a cost. Now, when building the business case for integrated reporting, management needs to address the cost associated with it. That is collecting and analyzing new type of data, setting up new data sets, hiring people with the proper analytical skills, setting up new internal control systems, assurance on the integrated report, and disclosing true information. Clear? That's it.
My question.
Sorry?
Sorry.
I think it's first.